Chapter 3. Mechanics and Dynamics of Charting. Traditional charting is a two-dimensional matrix upon which technical data or information is viewed. These quantitative analysts and statisticians employ various forms of time series and stochastic analysis and conduct back and forward testing on technical data. Technical data. Some of the more common technical data or information employed to construct charts include price data, open O, high H, low L, close C. Transaction-related data, volume V, open interest, opening parenthesis or I closing parenthesis. Market breadth data, advances A, decline D, total issues 1. Up volume, down volume, UV, TV. New highs, new lows, NH, NL. Bullish percent data, sentiment data, put call ratio, short interest ratio, specialist public ratio. Ratio, cash, asset, investor and advisor poll data, margin debt. Implied volatility, VIX. Quantization of price. Created. In order to create Ohlc data, we first need to specify the time interval over which price activity occurs. For example, let us assume that we are interested in identifying the opening, high, low, and closing prices over 5-minute intervals. We therefore need to separate or quantize price activity with respect to time for each successive 5-min interval or period. An interval or period may be of any duration, but the most popular intervals are 1 min, 5 min, 15 min, 1 hour, 4 hour, daily, weekly, monthly, and yearly. In our example, the price at the beginning and end of any 5-min interval represents the opening O and closing C price respectively, while the highest and lowest price within that period represents the high H and low L prices. In most cases, the closing price will also represent the opening price of the next 5-min interval unless there is a gap in price. Figure 3.1 depicts price activity within a 5-min period. Price is quantized into 5-min intervals and is summarized into 4 pieces of information, namely the Ohlc data. Note that Ohlc data is also used to construct other representations of price activity like bar charts, Gann bars, and Japanese candlesticks. The range of a bar or candlestick is simply the absolute difference between the high and low price, that is, range in Li. G. 1. Refer to figure 3.2. To create Ohlc data for bars and candlesticks over long periods, simply identify the opening price of the first period O2, closing price of the last period C3, highest price between the opening and closing price H4, lowest price between the opening and closing price L. Autoscaling attempts to fill the entire Autoscaling attempts to fill the entire screen with price activity. As such, the heights of bars and candlesticks constantly change, depending on whether price is ranging or trending. If prices are flat or ranging, it will expand all price activity and attempt to stretch it across the entire screen, making low volatility activity seem more volatile by increasing the height of all the bars and candlesticks on the screen. Conversely, when prices are trending, autoscaling will shorten the height of all bars on the switching of the autoscaling function normalizes volatility on the charts, allowing for more accurate price visualization. Refer (4) Lowest price between the opening and closing price L. Autoscaling attempts to fill the entire screen with price activity. As such, the heights of bars and candlesticks constantly change, depending on whether price is ranging or trending. If prices are flat or ranging, it will expand all price activity and attempt to stretch it across the entire screen, making low volatility activity seem more volatile by increasing the height of all the bars and candlesticks on the screen. Conversely, when prices are trending, autoscaling will shorten the height of all bars on the switching of the autoscaling function normalizes volatility on the charts, allowing for more accurate price visualization. Referring to the top two charts in figure 3.6, we observe a certain region of price activity encircled, being portrayed as more volatile than it really is by virtue of increasing the height of all its bars when prices across the screen are ranging or flattish. Significance of Ohlc data. The highs and lows represent areas of price rejection caused by the responsive actions of market participants. The durations between active trading sessions are longer. The opening and closing prices are created over a longer interval, i.e., belonging to a higher timeframe bar or candlestick. Single quote. In markets where the trading is continuous, opening and closing prices have lesser importance as compared to high and low prices, as in the case of the spot foreign exchange (FX) market, which trades continuously through the week from Sunday evening to the Friday close. 3.2 Gap action. 4 types of gaps. There are essentially 4 ways to define a gap, which is represented by a range of prices where no trading activity takes place. Type 1, a gap measured from the close of the previous bar to the open of the next or current bar. It is created instantaneously at the open. There is an instant jump in prices either up or down, with no trading activity taking place between the two prices. Type 2, a gap measured from the high or low of the previous bar to the open of the next or current bar. It is created instantaneously at the open. Type 3, a gap measured from the highs or lows of the previous bar to the highs or lows of the next or current bar. It is created only after the next or current bar has closed. Type 4, a gap measured from the close of the previous bar to the high or low of the next bar. It is created after the next or current bar has closed. See figure 3.9. It should be noted that of support or resistance, depending on whether price is above or below it. This is especially so when the gap created is a type 3 gap. The gap or price window increases in significance and importance with larger gaps. Prices are also generally expected to return to fill the gap at a later date, although there are many instances where this does not occur. Finally, it may be of interest to the reader to know that the average true range (ATR) is somewhat related to a type 4 gap, where the true range is either the range of the new bar or distance between the close of the last bar and the high or low of the new bar, depending on whichever is greater. 3.3 Constant chart measures. There are 5 types of constant measure charts, namely: There are 5 types of constant measure charts, namely: 1. Constant time charts. Bar closes when a specified time interval is met, for example, candlestick charts, bar charts, equivalent charts. 2. Constant range charts. Bar closes when a specified excursion in price is met, for example, point and figure charts and Renko charts. 3. Constant volume charts. Bar closes when a specified volume is met. 4. Constant transaction tick charts. Bar closes when a specified number of transactions, trades, is met. 5. Constant volatility charts. Bar closes when a specified amount of standard deviation or ATR is met. Constant time charts. Constant time charts quantize price activity into units of time, or intervals. Each bar is complete once a specified amount of time has elapsed. The bar range is variable. The bar duration is constant. Examples of constant time charts include Japanese candlestick, bar, equivalent, and line charts. Constant time charts represent the most popular form of chart construction. Bar charts as seen in figure 3.1. A bar chart is easily created via the quantization of price into specified time intervals or periods. Line charts. Time interval line charts are created by connecting all of the closing prices. Each closing price. Japanese candlestick charts. Japanese candlesticks are created in essentially the same manner as standard price bars, as seen in figures 3.1 to 3.3. The only difference is that the space between the opening and closing price is boxed up and is referred to as the real body. Equivalent charts. Equivalent charts are based on constant time-based bars, incorporating volume over a specified time interval. Constant range point charts. Charts. Axial increments on On constant range charts, each bar, box, or brick is complete once a specified excursion in price is met. The bar or box range constant. The bar or box duration is variable. The bar or box volume is variable. The transactions per bar is variable. The bar or box volatility is constant. Point and figure charts. Point and figure charts represent the most popular form of constant range charting. Renko charts. Renko charts are another form of constant range charting. The Renko bars are referred to as bricks. There are bullish white bricks and bearish black bricks. They are very similar to point and figure charting except that each new brick is plotted in a new column. A new brick is plotted once the minimum price excursion required for a new brick to be created is met. Since the creation of a new brick is not time dependent, the time axis as all reversals require price to move at least 2 bricks in the opposite direction. The plotted in a nonlinear fashion. Hence, Renko charts are essentially 2 brick reversal charts. Again, the size of brick is arbitrarily chosen. In linear scaling, equal distances on the In linear scaling, equal distances on the chart represent equal price changes. This would imply that equal price changes at higher prices would result in lower percentage changes. For example, a price change from $10 to $20 would represent a $10 change in price and a 100% change in price, that is, $20 $10, $10 by 100%. A price change from $90 to $100 would also represent a change of $10 in price, but at this higher price level, its percentage change is merely $100 $90, $7.90 by 100% equals 11.1% chance. For linear scaling, the percentage change is not preserved for equal units of price change. If P represents the north price, then linear scaling simply means that P's is a constant for every equal distance move on the chart. See figure 3.16. In ratio scaling, equal distances on the chart represent equal price percentage changes. If P represents the north price, then ratio scaling simply means that Pn equals Pn per peta-Newton minus 1 is a constant for every equal distance move on the chart. Figures 3.17 and 3.18 how the percentage increments need to rise to account for an equal price show change. This formula represents what is also referred to as stock returns. Linka scaling provides better upper end definition and visualization of prices, but relatively poorer clarity at lower prices. Ratio scaling provides better lower end definition and visualization of prices, but relatively poorer clarity at higher prices. It also does not affect overlay indicators that indicate horizontal levels of support and resistance, like prior support and resistance levels, Fibonacci extension, retracement, projections, and expansions, GAN 1/8 and 1/3 price retracement, GAN square of 9 price projections. It will indicate an uptrend line penetration that is later than that for ratio scaling but earlier than an uptrend line penetration based on a linear scale. Uptrend lines are penetrated sooner while downtrend lines are penetrated lower on ratio or logarithmically scaled charts. Uptrend lines are penetrated later while downtrend lines are penetrated sooner on linear or arithmetically scaled charts. The bid-based chart and bid-ask spread charts are typically drawn based on bid prices, although many charting platforms also allow for the display of price action based on ask and mid prices. It is also dependent on whether we are buying at the ask, buying at the bid, selling at the ask, selling at the bid.